The boardroom was quiet, not the tense kind, not the kind that precedes an argument. This was a finished silence. Coffee cups sat where they'd been placed 40 minutes earlier. Laptops were still open, screens dimming one by one. The term sheet lay flat in the center of the table, already signed. No one rushed to stand. No one celebrated. Someone finally said, "At least we know now." It sounded like relief. It felt like closure, but what no one in the room could see was how much had just been decided by choosing not to wait. The company wasn't fragile. By most measures, it was steady. Just over $42 million in annual recurring revenue, enterprise contracts, predictable churn, a burn rate that felt intentional, $1.6 million a month, runway 26 months. Enough time to think. The leadership team had built the company methodically. They hired slowly. They avoided spectacle. They rarely surprised their board. What surprised people instead was their restraint, and restraint held long enough starts to feel like exposure. Markets shifted quietly. Comparable companies raised not recklessly, just sooner. Some at higher multiples, some not. Each investor conversation circled the same idea without landing on it. We're still interested. We just don't know how long this window stays open. No one was panicking, but patience was no longer neutral. It was starting to feel like a position. What's often overlooked here is that nothing external had broken, only the tolerance for waiting had changed. The raise wasn't driven by ambition. It was driven by responsibility. A $65 million Series C flat valuation. Not a win, not a loss, just certainty. This story illustrates how responsibility in practice is often defined by how quickly uncertainty is resolved, not by how much optionality remains. Waiting one more quarter might have changed the multiple. Or it might not have, but waiting meant sitting with questions no one could answer yet. Questions that would only resolve with time. Revenue was growing, but unevenly. Sales cycles were lengthening. Forecasts still worked, but only if everything arrived on time. The offer on the table removed one variable. Cash extended the runway. Risk felt distributed. The board approved it quickly. The trade-off wasn't obvious at first, because nothing broke. But burn shifted. From $1.6 million to $3.1 million per month. Quietly. Hiring assumptions adjusted upward. Growth expectations recalibrated, not stated, just implied. The company hadn't committed to a direction. But it had committed to a pace. And pace, once set, is difficult to slow without consequence. The quieter factor was that no one felt comfortable being the first to question that pace, once it was financed. What does certainty actually buy when the future hasn't shown up yet? 3 weeks after the raise, leadership locked the hiring plan, not impulsively, carefully. A 3-year roadmap, modeled against demand that hadn't arrived yet but was expected to. Product expanded first. Sales followed. Infrastructure filled in the gaps. Every assumption worked on paper. Deals closing on schedule. Budgets unlocking without delay. Growth arriving smoothly quarter by quarter. None of it felt aggressive. The principle at work here wasn't optimism. It was coherence. Each assumption reinforced the next, leaving very little room for interruption. But together, the assumptions created momentum that didn't know how to pause. The company wasn't reacting to demand anymore, it was committing to it. Inside the team, something subtle shifted. Not excitement, relief. The questions had stopped. The plan had answered them. What mattered more than expected was not whether the plan was right, but how difficult it became to revise. Once people were hired into it, When does preparation stop being readiness and start becoming obligation? Nothing dramatic happened. No missed quarter, no sudden churn spike. But growth softened, not enough to alarm anyone, just enough to require explanation. Sales cycles stretched. Procurement slowed. One large expansion slipped a month then another. Burn stayed constant. The runway still existed, but it was moving faster now. Hiring continued not because it felt right, but because it was already planned. Product timelines stayed aggressive. Marketing spend remained committed. Reversing course would have required acknowledging something uncomfortable, that the certainty they'd bought hadn't reduced risk. It had rearranged it. This case shows how risk doesn't disappear when decisions are made early. It simply moves into places that are harder to unwind later. By month 14, leadership recalculated. The company wasn't failing, but it was heavier. Optionality had narrowed. A secondary transaction was arranged, clean, professional. It cleared at roughly 35% below the valuation implied by the raise. No headlines, no scandal, just math catching up to timing. The realization didn't arrive all at once. It surfaced in fragments, in budget meetings that felt tighter than expected, in roles that had been hired for futures that hadn't arrived yet, in conversations where no one could point to a single wrong decision, because there wasn't one. What had been misunderstood wasn't the market, it was the nature of risk. Waiting hadn't been passive, it had been informative, and acting early hadn't been bold. It had been comforting. The principle at work here was subtle. Learning requires exposure to uncertainty, and certainty arrived before the learning was finished. The raise removed uncertainty, but it also removed the ability to learn from it. The boardroom looked the same when it happened again. Different quarter, same silence. This time no one said, "At least we know now," because knowing hadn't been the problem. The problem was that by knowing early they'd stopped learning. Some decisions calm the room because they end discomfort quickly. Others leave the room uneasy but keep options alive. Neither approach is inherently right or wrong. The difference only becomes visible over time. The difference isn't obvious when the papers are signed. It shows up later when flexibility is either still there or already gone. The coffee cups stayed where they were. The meeting ended.